Gold-backed ETF holdings have declined since 2019 peak. So the red line is the tons of gold in the ETFs, and the blue line is the price. And this is more data proving that it is not the public doing this. This is declining while the price has gone ballistic. Why has the price gone ballistic? It's whales, it's China, it's everybody. It is not too late at all. But are you going to be a buyer at 5,000? Or are you going to wait until gold is 10,000 and then come rushing in with the rest of the herd? I hope not. I hope that you're somebody that educates yourself on all of this. Remember that that is the most important investment that you can make.
Amid rising concerns over the escalating global trade war, investors turned to gold-backed exchange-traded funds in significant numbers during the first quarter of 2025. According to the World Gold Council, inflows into these funds reached approximately 227 tons, the highest since 2022, fueling a 19% rally in gold prices over the 3 months. These strong inflows played a key role in pushing the yellow metal to multiple record highs, culminating in an all-time peak above $3,500 an ounce on April 22nd. Despite the surge in ETF demand during Q1, MikeMaloney of GoldSilver.com notes that overall global gold-backed ETF holdings have declined since peaking in 2019. This suggests retail investors may not be the primary force behind the rally. The trend is also reflected in central bank behavior, with India's Reserve Bank doubling the share of gold in its foreign exchange reserves over the past 4 years. By the end of March 2025, gold accounted for approximately 11.7% of India's total forex reserves, up from 9.32% in September 2024 and just 5.87% in March 2021. This strategic accumulation signals a growing reliance on gold as a reserve asset amid global financial uncertainty. China has also seen a sharp uptick in gold ETF activity, particularly in April. Chinese ETFs added 29.1 metric tons of gold in the first 11 days of the month, exceeding the total inflows for the entire first quarter. A key driver behind this surge was a regulatory change that permits insurance companies to invest in gold, opening the door for substantial institutional inflows. Overall, Chinese gold ETFs saw record-breaking inflows of 16.7 billion renminbi, approximately $2.3 billion, equivalent to a 23-ton increase in holdings. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
This is U.S. Mint gold coin sales, down. This is Perth Mint gold coin and bar sales, down. This is what the public buys, these things. This is silver coin sales, U.S. Mint, down. This is Perth Mint silver coin and bar sales, down. And I'm a dealer. Sales are down. I talk with other dealers. Sales are down just across the board. This is not the public driving the price. So here is a chart from Gergavin. Gold is outperforming the stock market by a whopping 42.5% so far this year. So we're talking the first 4 months. And what he's done here is indexed gold and the S&P 500 to 0 and on January 1st, and then tracked the percentage change. And the spread between them is 42.5%. It's huge. So who are the buyers? If the public is not driving the price up like this, who is doing that? Well, one of the big culprits are the central banks. And you can see here, ever since the global financial crisis of 2008, they have been net buyers. Now, this is mostly Asia. This is the East. This is India, Russia, Turkey, mostly China. So this is foreign central banks mostly doing these purchases. And this is through 2024. 2025 is going to go right off the top of this chart. It's going to blow everything else away. So who else could be driving the price of, if it's not the public in the US and probably not the public in Europe, who is driving this price up? Well, Reuters says Chinese gold ETF April inflows surpass first quarter total according to the World Gold Council. Now, here's the thing. This article is from April 14th. So, a little bit further down in the article, it says gold ETFs in China increased by 29.1 metric tons in the first 11 days of April. And that compares with inflows of 23.5 tons in January, February, and March, the first quarter. January to March, 23.5 tons, 11 days of April, 29.1 tons. Could this be what is driving the price? Yes. And so you've got January, February, March, and then the first 11 days of April. Part of what is driving that is this article is from February 11th, and China is allowing insurance companies to invest in gold. So this is institutional money that is coming in now. And that is, so it's whales that are driving the price of gold. But it's more than just whales. It's insiders, people in the know, people that know what is going to happen in the future. And Frank Giustra says that something must be done regarding members of Congress on insider trading. This is not a partisan issue. There's plenty of smoke on both sides of the aisle, and that's in response to Spencer Hakamian, I think. I don't know how to say his name. I'm sorry. The NASDAQ call volume spiked minutes before the 90-day tariff pause was announced. Not a good look at all. So people that knew what Trump was going to do just minutes before all bought calls on the NASDAQ betting that it was going to go up. And that is a bad look. And that is exactly, I believe, what is going on with gold right now. This is whales. This is also people in the know, and then they tip off friends that might be billionaires and stuff like that. Gold-backed ETF holdings have declined since 2019 peak. So the red line is the tons of gold in the ETFs, and the blue line is the price. And this is more data proving that it is not the public doing this. This is declining while the price has gone ballistic. Why has the price gone ballistic? It's whales, it's China, it's everybody.
Historical trends suggest that the Dow to gold ratio can be a powerful indicator of financial instability and shifts in market sentiment. During past economic crises, such as the Great Depression and the inflation-driven turmoil of the 1970s, the ratio dropped dramatically, at times reaching parity, where 1 or even 2 ounces of gold equaled the value of the Dow Jones Industrial Average. In 1980, amid peak stagflation, the ratio briefly touched 1-to-1, highlighting the relative strength of gold during periods of economic distress and stock market weakness. MikeMaloney now warns that we could be approaching an even more extreme scenario, where just half an ounce of gold might equal the Dow. In the early years of the Great Depression, the ratio plunged from around 18-to-1 to 2-to-1, reflecting a collapse in stock valuations relative to the rising price of gold. More recently, in 2018, the Dow-to-gold ratio again peaked above 18-to-1 after a decade of ultra-loose monetary policy. However, that year also marked a turning point. As the stock market stumbled and the Federal Reserve briefly attempted to tighten monetary policy, the ratio began to fall. When markets sharply corrected later that year, the Fed quickly reversed course, resuming quantitative easing to maintain liquidity. These shifts suggest that a declining Dow-to-gold ratio often precedes or coincides with broader financial crises. If the current trend continues and the ratio drops significantly, it could signal a broader economic reckoning, one in which gold again asserts its historical role as a store of value in turbulent times. Let's get back to the interview.
Part of it, I believe, is the threats to audit Fort Knox. Well, they're going to be auditing all of America's gold to prove that we've got it, but if it isn't there, we got to get it back. And I do know that central banks do gold leasing. And so right now, the gold inflows are refilling America's gold. We're closing out the gold leases, closing out rehypothecation of gold, it's called. And then this is the eligible ounces. Eligible is just gold that meets the specifications to be sold on the COMEX, but it is not for sale. The yellow is for sale. This is registered. And so in total, as of April 21st, it was at 94% coverage. So it's less of a fractional reserve scheme. However, I went to Nick Laird's website, goldchartsrus.com, and updated this is as of May 2nd, the last data that was available. So the total amount of gold stocks on the COMEX, there is now one person dancing for each chair that exists, each ounce of gold. So in this game of musical chairs. However, when you go to the registered category, the actual gold that's for sale, it's still 2 people dancing for each chair that exists, each ounce. But look at the craziness back in 2018 of more than 400 people dancing and settling in cash instead of asking for delivery. All of them thinking that they can lay claim to the same ounce of gold. And for a while back in early 2016, there were more than 500 people. That this is the type of fraud that this fractional reserve scheme is, where there are contracts to deliver gold 500 times the contracts of the actual gold that exists. So for each ounce, 500 people thinking they can lay claim to the same ounce of gold and have it delivered. Egon von Greyers, he is a great analyst. I love his stuff. The next gold move will surprise the world, and it will. Now, down inside his article, there's if the Dow gold ratio falls 97% to the long-term trend line of 0.5, it would mean gold 10,000, Dow 5,000, or gold 20,000, Dow 10,000. Now, what's interesting is this chart was in my first book, Guide to Investing in Gold and Silver. And when I ran across it, I speculated that there would come a day where gold's price would be double the points on the Dow. And that's what he's saying here. That brings it to a ratio of 0.5. And it is based on this trend line, but it's also based on all of the underlying fundamentals of the economics that are happening right now and the geopolitical tensions and the fact that we're in these enormous bubbles for real estate and the stock market, and that we're going into a recession, and then Trump has added tariffs to that, which could cause the entire planet to go into a global Greater Depression. Now, I want to point out a couple of things. The Dow Jones Industrial Average is 30 industrial stocks, and I believe it goes back to 1928. And then it's pasted to like the Dow, I think it was the Dow 23 or something like that. But then it's pasted to another index and another index and another index. I believe that the equilibrium, the natural balance between gold and stock market is somewhere between 2 and 5 ounces, actually 3 and 5 ounces. Equaling so the Dow should be 3 to 5 times the price of gold, and it's in equilibrium. When the Dow crashed 89% in the crash of 29, it bottomed in 1932 at just 2 ounces of gold, and then when the Dow went sideways for 16 years, gold became free trading, and gold came back with a vengeance and accounted for all the fiat currency that had been created in the meantime. And there was a day where gold was $873 and the Dow was at 873 points. So it only took 1 ounce. I do believe that this half ounce of gold is destiny.
Gold's meteoric rise in early 2025 highlights a shift in capital flows as institutional buyers and central banks intensify their metal accumulation amid growing economic unease. While exchange-traded fund inflows suggest heightened investor demand, the strategic repositioning by major players and nations underscores gold's renewed role in the global financial system. Meanwhile, historical benchmarks like the Dow-to-gold ratio flash warning signals, echoing past crises where gold surged as equities stumbled. This mounting divergence reflects eroding confidence in conventional assets and signals a possible inflection point in broader market dynamics. Could this intensifying preference for gold over equities mark the beginning of a more profound transformation in global investment behavior? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.